For decades, investors worldwide have been taught to believe in a very simple idea. Bonds are safe. The logic seemed unquestionable. You buy a government bond, receive interest regularly, and at maturity you get your money back. For many institutional investors, pension funds, and even individual investors, bonds have always been considered the most stable pillar of a portfolio. But the reality of financial markets is far more complex than this simple narrative. Markets don't operate in a straight line. They operate in cycles, and more importantly, they operate under different economic regimes. For more than 40 years, the global bond market experienced an extremely favorable environment. Interest rates fell consistently, inflation remained relatively controlled, and central banks managed to maintain a high level of financial stability. This period created what many analysts call the Great Fixed Income Bull Market. But when a cycle lasts 4 decades, an inevitable question needs to be asked. What happens when that cycle begins to change? That is precisely the question I want to discuss today. In recent years, several signs have begun to appear on the global macroeconomic horizon. Growing fiscal deficits, historical levels of public debt, significant changes in monetary policy, and structural pressures that could alter how the bond market functions. These factors don't appear all at once. They accumulate slowly, and when they finally begin to converge, markets can change much faster than most people imagine. That's why today I want to raise a possibility that few investors are really discussing with the necessary seriousness. There is a real chance that 2026 will become a major inflection point for the global bond market. I'm not saying a crisis is inevitable, but I am saying that structural risks are increasing. And investors who ignore these signs usually end up reacting too late. So in the next few minutes, I want to show exactly what these structural factors are, why they are accumulating now, and why 2026 could become one of the most challenging years for fixed income investors in a long time. Because in the financial market, understanding major cycles before most people makes all the difference. To understand why 2026 could represent a significant risk for bond investors, we first need to go back a few decades and look at one of the most important phenomena in the history of financial markets. For more than 40 years, the world experienced an extraordinary period in the fixed income market, a prolonged cycle of falling interest rates. This cycle began in the early 1980s when central banks finally managed to control the extremely high inflation that had dominated the global economy in the 1970s. In the United States, the financial system underwent a profound transformation when the Federal Reserve adopted much tighter monetary policies to combat inflation. Interest rates were raised aggressively during that period. This caused a temporary recession, but it also laid the groundwork for something very important: the beginning of a long process of global disinflation. When inflation starts to fall, interest rates usually follow suit. And here comes a fundamental principle of the bond market. When interest rates fall, the prices of existing bonds rise. This means that investors who already held bonds in their portfolios began to register capital gains in addition to the income generated by interest coupons. This phenomenon created an extremely favorable dynamic for fixed income investors. Over the following decades, pension funds, insurance companies, banks, and institutional investors built entire strategies based on this environment. The logic seemed almost automatic. Gradual drops in interest rates boosted the value of bonds. This generated relatively stable and predictable returns. But here's the point many investors ignore: this type of environment doesn't last forever. Financial markets move in long cycles, and when a 40-year structural cycle begins to change direction, the consequences can be significant. If interest rates stop falling and start rising more persistently, the logic that has sustained the bond market for decades begins to reverse. And when that happens, investors who are positioned for an older regime may face a completely different environment. That's why it's so important to understand that the great cycle of falling interest rates, which has benefited investors for so long, may be coming to an end. And if this change is really happening, the impact on the global bond market could be much greater than most people imagine. Now that we understand the great cycle of falling interest rates that dominated markets for decades, we need to look at a factor that is at the heart of the current risk in the bond market: debt. Today, the level of global indebtedness has reached historically high levels. Governments, companies, and even families have accumulated extraordinary amounts of debt over the past few decades. But the most critical point is public debt. In the United States, for example, the federal government has operated with persistent fiscal deficits for many years. Simply put, this means the government spends far more than it collects in revenue. When this happens, there is only one way to finance this difference: issuing more bonds. And that is exactly what has been happening. Every year, trillions of dollars in new Treasury bonds enter the market to finance these deficits. For a long time, this process seemed manageable. This is because interest rates were relatively low, making the cost of debt easier to sustain. But here's the critical point. When the total level of debt becomes very large, small changes in interest rates can have enormous effects on the government's financing costs. Imagine a simple situation. If a government has relatively little debt, an increase in interest rates has a limited impact. But when debt is already at extremely high levels, any increase in rates means that an ever larger portion of the budget needs to be allocated solely to interest payments. This creates a difficult cycle to control. The more debt there is, the more bonds need to be issued to finance future payments, and the more bonds enter the market, the greater the pressure on investors who need to absorb this growing supply. This is a fundamental point that many investors underestimate. The bond market depends on a delicate balance between supply and demand. If the quantity of bonds available increases faster than investor demand, prices tend to fall, and when bond prices fall, interest rates rise. This dynamic may seem technical, but it is at the heart of what could happen in the coming years, because if debt levels continue to rise and the issuance of new bonds continues to accelerate, the market may begin to demand ever higher yields to finance that debt. And when that happens, the impact on fixed income investors can be far more significant than many realize today. Now, we need to look at a very specific aspect of the fixed income market that often goes unnoticed by most investors: the volume of bond issuance. When we talk about public debt, many people only imagine a large number, trillions of dollars accumulated over time. But in the actual functioning of the market, there is a continuous process happening behind the scenes. Debt needs to be constantly refinanced. Bonds have maturities. Some mature in a few months, others in 2 years, 5 years, 10 years, or even 30 years. When a bond matures, the government needs to pay that amount to the investor. But in practice, what usually happens is this: the government issues new bonds to replace the old ones. This process is called debt refinancing. In normal periods, this system works relatively stably. The market absorbs the new bonds and the process continues. But what we are seeing now is something different. In the coming years, extraordinary volumes of debt will need to be refinanced. At the same time, fiscal deficits continue to generate new and additional bond issuances. This creates a rare situation, a huge amount of supply entering the market almost simultaneously. And here comes one of the simplest laws of economics. When the supply of something increases significantly, but demand does not grow at the same rate, the price needs to adjust. In the bond market, this adjustment happens through interest rates. If investors are unwilling to buy large volumes of bonds at current rates, the market needs to offer higher yields to attract buyers. This means rates go up. For many years, this risk was partially mitigated because there was an extremely powerful buyer absorbing much of this issuance. That buyer was the central banks. But now we are entering a different environment where this dynamic could change significantly. If demand is insufficient to absorb this avalanche of new bonds, the market could undergo adjustments much faster than most investors expect. For more than a decade after the 2008 financial crisis, global markets underwent an unprecedented monetary experiment. Central banks adopted extremely expansionary policies to stabilize the financial system and stimulate economic growth. First, it increased liquidity in the financial system. Second, it artificially reduced long-term interest rates. And third, it created an extremely powerful buyer within the bond market. During this period, investors knew there was enormous force sustaining the demand for bonds. This helped keep yields relatively low for many years. First, it increased liquidity in the financial system. Second, it artificially reduced long-term interest rates. And third, it created an extremely powerful buyer within the bond market. During this period, investors knew there was enormous force sustaining the demand for bonds. This helped keep yields relatively low for many years. But now we are in a different phase of the monetary cycle. In recent years, central banks have begun to face a problem that had disappeared for a long time: the return of inflation. To combat this scenario, monetary policies needed to change, interest rates were raised, and at the same time, central banks began to reduce their balance sheets. This process is known as quantitative tightening. In simple terms, it means the central bank is allowing bonds that were on its balance sheet to mature without fully reinvesting those funds. This has a direct effect on the market. One of the largest bond buyers is gradually reducing its presence, and when such a large participant begins to withdraw, the balance between supply and demand can shift rapidly. Other investors need to step up to fill that role. But these investors typically demand something in return: higher interest rates to compensate for the risk. This is one of the reasons why the current environment may be very different from the one that dominated the market for more than a decade. The monetary support that helps stabilize bond prices is diminishing, and this could leave the market much more sensitive to the natural forces of supply, demand, and fiscal risk in the coming years. When investors analyze the bond market, most focus on immediate factors: inflation, interest rates, and monetary policy. These factors are important, but there is a much slower and often far more powerful structural force influencing the future of developed economies. That force is demographics. For much of the 20th and early 21st centuries, many advanced economies benefited from relatively young and expanding populations. This created a broad base of active workers capable of sustaining economic growth, tax revenue, and retirement systems. When the economically active population grows, governments receive more taxes, businesses produce more, and economic growth tends to be more stable. But now we are entering a very different period. In several developed economies, including the United States, Europe, and Japan, the population is aging rapidly. This creates a structural shift in how the economy functions. As the population ages, two things happen simultaneously. First, governments need to spend significantly more on social programs, especially pensions and healthcare systems. Second, the ratio of active workers to retirees is beginning to decline. This means that fewer people are contributing to finance a larger number of beneficiaries. From a fiscal perspective, this is an extremely difficult equation to balance. Governments face increasing pressure to raise mandatory spending while the tax base grows more slowly. The result, in most cases, is persistent fiscal deficits. And when deficits persist for long periods, they eventually become inevitable. More public debt issuance. More debt means more bonds being issued in the market. And this brings us back to the central point we are discussing. The greater the volume of bonds that needs to be absorbed by investors, the greater the pressure on interest rates in the long term. Demographics don't change rapidly. They evolve over decades, but precisely for that reason, when these trends begin to affect public finances more intensely, their effects can become profound and lasting for financial markets. After analyzing all these factors, the end of the great cycle of falling interest rates, the structural increase in public debt, the avalanche of bond issuance, and demographic changes, a natural question arises. Why specifically could 2026 become a critical moment for the bond market? The answer lies in the convergence of several economic and financial cycles at the same time. In the coming years, a very large amount of previously issued debt will need to be refinanced. This is because many bonds issued during periods of extremely low interest rates are nearing maturity. When these bonds mature, they need to be replaced with new ones. But there is an important difference now. Much of this debt was issued in a near zero interest rate environment. When it is refinanced in a higher interest rate environment, the cost of financing increases significantly. This creates direct pressure on public budgets. At the same time, global economic growth may face a slowdown at certain periods of the cycle. When economies slow down, tax revenues tend to grow more slowly, while public spending often increases to support economic activity. This is an environment that tends to widen fiscal deficits. Furthermore, there is still an important variable in the macroeconomic scenario: inflation. Even though inflation has decreased compared to recent peaks, many structural factors, such as the reorganization of production chains, geopolitical tensions, and changes in the labor market, can maintain inflationary pressures present in various sectors of the economy. When inflation remains uncertain, investors demand higher yields to offset that risk when buying long-term bonds. Now imagine these three elements occurring simultaneously: large volumes of debt refinancing, persistent fiscal pressures, and a still uncertain inflation environment. When these factors converge, the bond market can become much more sensitive to changes in expectations. And it is precisely at times like this that investor behavior can change rapidly. Because when the market begins to question fiscal sustainability or the appropriate level of interest rates, adjustments can occur much faster than many imagine. During times of economic transition, there's a recurring mistake in investor behavior. This mistake is simple, yet extremely common. People tend to project the past onto the future. When something works for a long time, the human brain begins to treat that pattern as if it were permanent. This happens in all financial markets. Investors observe 40 years of gradual decline in interest rates and come to believe that this environment will continue indefinitely. But economic history shows exactly the opposite. Markets move in different regimes over time. For example, in the 1970s and early 1980s, the world experienced a completely different period than what we saw in the following decades. Inflation was high, interest rates were much higher, and economic volatility was much greater. After that, a long period of disinflation, monetary stability and falling interest rates began. It was in this environment that the global bond market prospered. But today we are seeing signs that some of these structural conditions are changing: greater fiscal pressures, changes in global production chains, profound demographic transformations, and a more fragmented geopolitical environment. These factors may create an economic regime different from the one that has dominated the last 40 years. And when regimes change, some traditional strategies cease to function in the same way. For example, many institutional portfolios were built on a very specific logic: stocks on one side and bonds on the other. For decades, bonds often acted as a hedge when the stock market fell. But in certain economic regimes, especially when inflation becomes a significant variable, this relationship can change. This means investors need to look at their portfolios with a different mindset. Not assuming that the future will be identical to the past, but analyzing whether macroeconomic fundamentals are pointing to a new type of financial environment. Investors who can recognize these regime changes early are usually able to adapt. Those who remain stuck in past patterns are often surprised when the market finally adjusts to the new reality. After analyzing all these structural factors — growing debt, changes in monetary policy, demographic pressures, and possible shifts in the economic regime — an essential question arises for any investor: what to do in this scenario? The first thing is to understand that in environments of greater macroeconomic uncertainty, risk management becomes more important than simply seeking returns. For many years, investors operated in a relatively predictable environment. Interest rates were trending downward, inflation was moderate, and global liquidity was abundant. In this type of environment, many risks seemed smaller. But when the regime changes, the way to build portfolios also needs to evolve. One of the most important points for fixed income investors is understanding the impact of bond duration. Duration is a measure that indicates how much the price of a bond can vary when interest rates move. Long-term bonds, for example, are much more sensitive to changes in rates. Even small variations can generate significant movements in the market value of these assets. This means that investors need to carefully assess their exposure to very long-term bonds in environments where rates may remain more volatile. Another important point is credit quality. Not all securities carry the same level of risk. In periods of economic stability, investors often seek higher returns by taking on more credit risk. But in more uncertain macroeconomic environments, analyzing the financial soundness of issuers becomes much more relevant. Furthermore, true diversification plays a central role. Diversification doesn't just mean owning many different assets. It means owning assets that actually behave differently in distinct economic scenarios. Investors who understand this are able to build more resilient portfolios, because ultimately the main goal of any long-term investment strategy isn't just to grow wealth, it's to preserve capital throughout economic cycles. And those who manage to weather difficult periods while keeping their financial base intact are usually in the best position to seize the opportunities that arise when the next cycle begins. After analyzing all these elements, the end of a 4-decade cycle of falling interest rates, the structural growth of public debt, the increasing need to issue bonds, demographic changes, and the possibility of more persistent inflationary pressures, it becomes clear that we are facing a very particular moment in the history of financial markets. None of these factors in isolation guarantees that there will be a crisis in the bond market. But when several structural factors begin to align at the same time, the most experienced investors know that they need to pay attention. Financial markets rarely change direction, slowly and perfectly predictably. Most of the time, they remain relatively stable for long periods, until something changes in investor expectations. And when that change happens, the adjustments can be rapid. That's precisely why understanding major macroeconomic cycles is so important. Investors who only observe short-term movements often miss the structural signals that are forming over several years. On the other hand, investors who follow long-term trends are able to perceive when the environment is beginning to change. Today, there are clear signs that the global bond market may be entering a new type of economic regime, a regime possibly characterized by greater volatility in interest rates, greater fiscal pressure, and a different role for fixed income within portfolios. This doesn't mean abandoning bonds altogether. It simply means that the environment may demand more analysis, more selectivity, and more risk awareness, because ultimately, investing isn't just about finding opportunities. It's about navigating complete cycles. It's about protecting capital when risks increase and being prepared to act when new opportunities arise. And investors who can consistently do this are the ones who truly build wealth over time. If you want to continue learning about macroeconomic cycles, global markets, and wealth protection strategies inspired by Jeffrey Gundlach's analyses, subscribe to the channel now Because understanding cycles before most people do is one of the most valuable skills any investor can develop.